So, how would we get better mortgage terms in today's world? Hey guys, my name is Sandy. I'm doing a video for you today on how to get better mortgage terms. We're in 2025, interest rates are kind of high, inventory kind of high, homes are not selling as fast as they used to. You have a little bit more bargaining power based upon the seller you're dealing with. If it's a builder, you have more bargaining power. They don't want to sit on the properties. If the seller is very motivated, you may have better bargaining powers. But now, how do we set ourselves up in purchasing a home to get better mortgage terms that will help us with a lower monthly payment? Let's get into it. Okay, so the first thing you want to do, number one thing is improving your credit score. The higher your credit score, the better bargaining power you're going to have. The lower your credit score, you're going to get a higher interest rate and you're going to be penalized for having a lower interest rate. For having a lower credit score. I keep messing up interest rate and credit score. So the first thing you want to do if you're thinking of buying a home is, okay, what is my credit score right now and how can I improve it? There are different ways you could do. You could pay down some debts that are on the that's on your credit report, or pay some of your debt down. So make sure you consult a credit specialist to try to get your credit score as high as it possibly can get. The higher you are to 700, the better. High 600s is great. 620 and above, great. Below 620, now you are on the train of higher interest rate, and they're going to be scrutinizing everything you give them, all the paperwork, because your credit score is low. So to the bank, you're a higher risk for them. So you definitely want to improve your credit score. One of the ways of doing that is also improving your debt to income ratio. The bank is going to be looking at that. What does that mean? It means if you're making $2,000 a month, the bank don't want you to have $2,000 in debt, because that debt to income ratio would be 0, right? So if you're making $2,000 a month, the bank wants to see you doing $500 or less in expenses or in debt. Believe it or not, that's a great ratio. A better ratio would be, I'm making $2,000 a month, but my debt is $800 a month. So that's pretty cool, right? I don't want to bore you with the percentage, but that would be pretty cool. I'm just doing it basically right now. So you want your debt, and the way they see debt is the debt that's reported on your credit report. So these debts are going to include your credit card payment, your car loans, any student loans that you may have, any financing you did, maybe you bought some furniture or whatever that is, that's going to show up on your credit report. So you want to bear in mind that anything that shows up on my credit report is going to count against me as debt. So the less amount of money I have on my credit report, the better. If you have a credit card, let's talk about credit cards for a minute. If you have a credit card and your credit card limit is $10,000, you don't want to max it out, right? Especially if it's in your personal name. We're talking about everything in your personal name right now. Forget about business. So in your personal name, if you have a credit card for $10,000, you want to spend only 25% of that amount each month, and you want to pay it off at the end of the month. This is how you manage your credit or your debt. So the credit card debt, you don't want to go 25%. If you find yourself going up towards 50%, you may want to take a break, do a little red light and say, okay, I can't charge anything else on this card. Unless it's an extreme emergency of life and death, I cannot charge anything else on this card because I'm going too close to the 50% mark. You want to keep it down at 25%. I know life happens. I know sometimes you got to do stuff that you didn't plan on doing, but the more you're able to keep that credit card 25% or less and paid off at the end of each month, you're showing the bank that you have credit responsibility and you're not maxing out all the credit that you have. Now, if you have a student loan, this is going to be very, very important because the banks look upon student loans very strictly. Make sure you're current on your student loan. If you have a deferment in payment, make sure you have an explanation for that written. I know sometimes they will grant certain deferment on student loans, so make sure you have that written. Your student loan have to be current. If you're behind on student loans, try to catch up on that because that's going to be a big red flag for the bank. If you have medical debt, You may want to call the medical institution and see if they could work something out where they'll take a less amount to pay off your debt or whatever the situation is. But the bank is going to completely look upon your credit score and your credit report. The cleaner that looks, the better you will be. That's very, very important. Next thing is you want to shop different lenders, right? You don't want to just go to one lender and be like, okay, I'll do it. So you want to shop lenders. But in shopping lenders, you don't want all of them to keep pulling your credit score. So it may not be a bad idea to go to a mortgage broker. Mortgage brokers have a wide variety of different lenders that they use. And based upon your particular situation, they might say, okay, since your credit score is X and your debt to income ratio is Y, these lenders may be the best lender for you. Let me present your situation to each of them and see what I get and see what they come back to me with. Mortgage brokers also have relationship with these lenders that they're working with. So they could always go and give a scenario to that lender or the lender representative saying, hey, I have a client. This is their situation. What can we do? What would their monthly payment look like? What would their down payment look like? What would their interest rate look like? So mortgage brokers are the better way to go if you're shopping for the best mortgage. Now, if you're going to a builder, the builder is going to have their assigned lender. You really can't shop lenders when you're going to a builder because the builder is going to have their own lender. However, because they work with this particular lender and they do so much volume of loans for them, they're going to have different incentives. They're going to have stuff like paying on your closing costs or paying on your interest rate or whatever it is they have. So for new construction, you really can't shop lender because there's no lender that's going to be the builder's lender. There's just none, because the builder's lender, again, have incentives to work for the builder because they're giving them so many loans. So you won't be able to beat that. That's another thing. Now, what are we looking for when we are shopping loans, right? We went to a mortgage broker. Now we're shopping loans. We're looking for different mortgage programs. Is there any mortgage program that's going to allow me to put no money down? And if I'm putting no money down, what does my monthly payment look like? Now, we have to really examine no money down, because no money down doesn't necessarily mean that's the best deal. Because what does that look like long term, and what's the monthly payment? Can I afford it? So we're going to look at different, maybe there's a loan program that will allow you, the lender will give you some lender's credit to put towards your closing costs. That's something to look forward to instead. Of course. Interest rate structure. Is it going to be a fixed interest rate? Is it going to be an adjustable interest rate? When does it adjust? Am I able to buy down points up front? The more points you buy down up front, the lower your interest rate will be. A lot of builders are doing this. They're buying down the interest rates for you, right? They're buying down points. So can I buy down point? How much point can I buy down? How much money that is? 1%, buy down 1% of the loan may be a great deal if you can afford to. But how, and if I can't afford to do that, is there another option? So those are some of the things to take in mind. The term of the loan also. Is it a 15-year loan? Is it a 30-year loan? I've heard situations where sometimes I do a 40-year loan. What does that look like for you? Now, I always tell my clients this. It doesn't matter how long of a term the mortgage is. Most people don't pay off their mortgage anyway. I mean, very few people live in a home for 30 years and pay off that 30-year mortgage. So most of the time what happens is people buy a property, they live in there for 5 to 10 years, they sell that property to buy another property, right? So you're looking for equity to build. You're not looking to pay off the mortgage. So who cares what the mortgage is and at the end of it? We don't care because we're not paying it off anyway. We're going to probably more than likely sell that property and buy another property. So the thing to bear in mind is the monthly payment. How affordable is the monthly payment? Because you have to be able to pay the monthly payment. And even if the lender is saying to you, or the mortgage broker is saying to you, your payment is going to be whatever it is, make sure you're comfortable with that, because you also know what other expenses come in your household. Maybe you have private school bills with your children that's not showing up on the credit report. So you know what kind of other expenses you have that's not showing up on that credit report, that you know you're going to have to keep that in mind. Traveling expenses, grocery, utility bills, all that great stuff. So make sure you keep all that stuff in mind. Now, we mentioned buying down points. In today's world, because interest rates are so high, it's not a bad idea to try to buy the points down, right? And that's something you would discuss with your lender or the mortgage broker. Once again, if it's a builder, different story. Let's pretend it's not a builder. The best thing is to go to a mortgage broker to see what programs they offer. They will only pull your credit one time, but they're able to shop different lenders. And a lot of times they're able to pull the file from one lender if they're not doing what they said they would do and give it to another lender. Sometimes lenders are calling mortgage brokers because that's where they make their money. So they're going to tell the mortgage broker, hey, we just have this new program that come up. Hey, we have this other program that just came up. So a well-informed mortgage broker will be able to shop the loan for you without them pulling your credit report all the time. You don't want to keep doing that. I think you're allowed to pull up to 3 times in a 30-day span or something without being penalized. You don't want to really exercise that. Better for you to go to a mortgage broker for them to shop the loan for you to see what programs is out there that they could use. They don't have to pull your credit score either. You could ask them, hey, what programs do you have available for people with a credit score of 620, making an income of X amount per month? Of course, they're going to say, well, we got to really pull your credit score. But you don't want them to do it. You just want them to tell you what programs they have that would be able to do that. Hopefully this helps. If you have any questions, just send us a call, send us a text, give us a call. Why do I always mix this up? Our number should be somewhere up here or somewhere below. It's a wide topic, guys, but in today's society or in today's world or today's economy, buying a home is going to be super important for you to shop mortgages because interest rates are not that low. We don't know if they'll ever get as low as they were back in 2020 and 2021. So we have to shop to get the best rate. Thank you so much for watching. See you in the next video.